Hi all. So thanks for attending our webinar series on DCF modelling. My name is Ed O'Hanrahan and I'm the UK Sales Manager for Forbury. So to give some context to who Forbury is, we have a cloud-based real estate modelling tool that's used globally by Transactions Group. So if anyone's interested in finding out some more about us, then give me a shout after this webinar and be good to link up. So to kick things off, we are putting, or I suppose, why are we putting on this series? I'm sure you've all recently read the RICS report regarding the shift to DCF modelling. So off the back of that, we thought it was a great opportunity to put on a refresher course so people can dust off the cobwebs and just kind of dive back into it. So in terms of what to expect, we've got Scott Wilson, who is Forbury's CEO, and we've also got Dan Hughes, who is the founder of Alpha Property Insight, discussing basic DCF principles, followed by a Q&A session afterwards. So if anyone's got any questions as we go, feel free to just jot them down in the chat window and the guys will jump into them after. Also, final note, this session is being recorded, so we'll send it out to everyone afterwards, and anyone that's missed it, we can fire it across as well. So quick summary in terms of our host. Dan Hughes, the founder of Alpha Property Insight. So Dan helps the property sector embrace and benefit from innovative thinking and digital transformation. And then we've got Scott Wilson, CEO of Forbury. So Scott's an expert in analysis and financial modelling, and has been influential in growing Forbury from the ground up. So guys, with no further ado, I'm going to hand the floor over to you and let you kick things off.
Awesome. Well, thank you very much, and thanks very much for having me here. It's really good to have this session. I think refresher on this sort of thing is really important. So I was just going to set the scene a little bit before I hand over to Scott to talk about some of the more technical bits for a few minutes, which is that a couple of years ago, I wrote a report about the future of valuations generally and commercial property especially. And part of that was about understanding what the clients of valuations thought of the process and the product that they were getting. And it was very clear that there are a couple of themes coming out of that. And one of them was around trust. So can those be trusted? And even if it can be, can you be confident about that? Another one was about the fact that the world is just changing. Everything is changing about it. And this was before COVID, which has changed things even further. But everything's getting faster. We're looking at all sorts of different factors that influence the value of a building, much more about the environment and people and so on. And also that data is becoming far more important. So the way that data is being used, both the existing data, for example, in a DCF, but also some of that wider data is becoming more important. So really pleased to be part of this session. I think it's really important. And it was really good to see the RICS review look at all of these topics and pull out a few things. It really picked up on predictive analytics and where that's going in the future. It really picked up on a number of things around trust and how you structure the deals. And I think that's really important moving forward. And one of the really key parts of that is that as the world evolves, it's recommending that we move to a DCF approach. So I think this is going to be a really useful session. I think it's a really positive step forward for the sector. And so really looking forward to hearing from Scott a little bit about this and then getting into a conversation a bit more about some of the wider challenges and topics. And just to reiterate, please do chuck in any questions into the Q&A because it's always good to get those and get some feedback. So Scott, maybe I can hand over to you for a couple of minutes and then we'll go through a bit more afterwards.
Sounds good. Thank you, Dan. And good morning, everyone. Thank you for joining us. So as we talked about, we will run through in this session a bit of a basic overview of what DCF is, what the principles are that underpin it as a valuation methodology, what its use is, its history, and some other consideration, I guess, for additional data requirements that may be required as part of conducting a DCF analysis. We'll have a bit of a discussion based on the Q&A that's coming in, and really looking forward to getting into it. Okay, so really quickly, starting with a bit of a history in discounted cash flows. Goes back a long time, and back to the 1930s, and Mr. Irving Fisher, who came up with the theory of interest. And those of you that are across your economics history would know this one. This was the concept that there is a real interest rate concept. So a reserve bank will often set a nominal interest rate, and there'll be a level of inflation in the economy, the difference of those two being the real interest rate. Then along came John William with the theory of interest value as well. So that was the intrinsic value of a company is the present value of future dividends, not future earnings, which is quite an important distinction. And these two gentlemen really set the scene and created the context for documenting what are modern discounted cash flow methods in economic terms. In the 50s and 60s, some of you will recognize this gentleman, Mr. Myron Gordon, who was most famous for the Gordon growth model, which assumed that companies would forever grow and that the dividends would forever grow as well. And on that basis came up with another methodology for evaluating stocks and companies, and that was something which really took the William concept further and introduced growth into the model. Where we've got to from the 90s and today is a concept where equity valuation, and actually more broadly across other financial asset classes like property, infrastructure, bonds, fixed interest, where you've got discounted cash flows becoming very much the dominant valuation methodology. Modern computing, meaning that can handle a lot of permutations and scenarios, and really looking to understand what that means for shareholders in a particular asset or financial instrument. Next slide, please. Okay, so just a couple of applications that are pretty common outside of property, or a couple that are in property and also a bit more broadly beyond it. The most common one is an equities analysis, and it's pretty common for company reports, expectations of earnings to be reported by management and the board during an earnings call, and sometimes they'll be discounted and can be discounted rather than to a price. And this is really common in private equity, especially for young companies where they might have fluctuating earnings. Having an understanding of what that profile looks like over a period of time is important to conduct a valuation, especially if you're investing in that company. It's also a really good check to test inputs relative to market assumptions, especially when the markets feel like they're quite tight or quite loose as well. So an example of this would be an environment where there's a lot of demand on equities. Maybe PE multiples look like everything's a little bit overvalued. It's a really good sense check to be able to run earnings expectations carried forward based on growth rates to understand what that would mean from a current share price and what growth has been priced into the current share price. Another one is real estate development. So in a commercial context, this would look like what stage development is going to take place before a development is complete, what the CapEx requirements are out to the completion of a project, and whether that's what that valuation looks like on completion through a trade sale or potentially as a held asset is quite an important understanding to understand what the project valuation is itself. And this goes through to other types of real estate as well. So if you consider a residential real estate development where there might be an associated sell-off at the conclusion of a project, having an understanding of the total life cycle value of that project is quite important. And then finally, resources. For example, you might have a resources group that have some estimates on a reserve estimate based on how many millions of tons of iron ore or copper they may expect to mine from a particular resource. They will have to remove the dirt that sits on top of it. They will have to then extract the resource associated with it and then get the product into international markets where there's associated price and exchange risks and shipping to market risks. So having a broad understanding of what the cost up front as well as the traded price once it's available is a really important aspect of how valuations are performed in the resources sector as well. Okay, so what are the specifics? DCF 101. So really simply, it's a method to determine the value of an investment based on its expected future cash flows. So that does require making assumptions about the future to understand what those future cash flows are, and then taking a view on what discount rate to use to determine the present value of those cash flows. So really simply, it's 3 steps. Determining what those future cash flows are through assumptions and projections, selecting an appropriate discount rate, and then discounting those future cash flows to get them in today's dollars. So some principles that are at work here: near-term cash flows are discounted less than longer-dated expected cash flows. So if you go back to the real estate development scenario we were talking about before, it's incumbent on developers to really develop assets out and meet contracted commitment dates, because often they're penalized if they don't, but also because they're really looking to get into the aspect around what is positive cash flow sooner rather than later. So the delay and the deferral of income or cash flow that's net positive really does hurt a DCF valuation to quite a large extent. And the discount rate that gets applied, it will determine the discounting velocity. So for example, if you are looking at a really risky asset, potentially an asset that's in a location that's got more risk associated to it, you might apply a high discount rate. So future cash flows from that will have a lower present value, whereas a low discount rate potentially is something that's it's core, it's a lot more certain. Maybe the tenant composition and the credit worthiness of those tenants is very solid. Then the future cash flows from a lower discount rate will have a higher present value and therefore get punished less when it comes to a DCF valuation. When it gets to the maths, there's a bit of a screenshot at the top here which sets it out, but really there's a kind of this discounting effect where you are looking at taking the discount rate and bringing forward or calculating a discount factor for each period you're generating and forecasting a cash flow. So you would see that start to diminish as you get further into a hold period, and then this concept of a terminal value at the end of it. So you would have a period of time that you are preparing your forecasted cash flows for, and at the end of that period you'd take a view on what the residual or completed value looks like at the end of the hold period, and also discount that back into your assessment as well. Okay, next slide. So to illustrate what this looks like for a commercial property, here's an example of a single tenant in a property. This tenant has around about 3.5 years to go on its contracted term. It's got one rent review remaining midway through that term, which you can see with the light blue color there lifting slightly to meet the ERV, 18 months into the hold period. Then the tenancy concludes and you've got this void, this income void, while the landlord is looking to release the space. There's a period of a void period of around about 6 months, and then on the release of it, the ERV is setting the base rent. There's a 5-year period before there's a next review, and you can see it uplift towards the end of that 10-year period. Also, there's a refurbishment cost that's associated with retrofitting that space to make it possible to release again as well. So this is a bit of the forecasting that's required that goes on with this would be to prepare and understand what the cash flow expectations are by tenant across your portfolio of properties, or the tenants in a property that you're looking to value, as a really important part of understanding and forecasting those cash flows. So just bring this illustration back to the previous slide as well. And sorry, next slide. To add some numbers and highlight what we're talking about here when we start getting into discounting, that total base rent, which looks like the contracted base rent plus the renewal base rent in that year of 2025, you'll see a bit of a mix of the two going on there. But most importantly is what's happening in the second to last line here. So we're assuming in this example a discount rate of 8%. And what that will mean is the discount factor associated with each year in the cash flow starts to diminish. And because the number, the total base rent that we're subjecting that to is going to be multiplied by that discount factor, you really want to, I guess, get near-term cash flows to generate a high value using the DCF. This example, of course, doesn't take into consideration any terminal value associated with this example, or the present value effect of the refurbishment cost as well, but it's just to illustrate and draw a bit of detail out around what that discounting looks like in practice. Okay, so from a valuations perspective, completing a DCF valuation obviously brings into the equation more assumptions required to forecast cash flows over time, and more investment parameters that are required to generate the discounted cash flows as well. So you've got the discount rate. In the example I used before, that was the 8%, and that's something that there's a lot of theory behind what discount rate you'd adopt, but it really is quite specific to the asset that is looking to be valued and exactly what's specific about it. There's an exit valuation. So what does that residual valuation look like if we're assuming that the owner of this property is going to continue to hold it for another 10 years? What is the estimate at the end of that 10-year period in terms of an ongoing valuation? There are letting up assumptions associated with what happens when an existing or a sitting tenant concludes their lease. What void period are we going to have to consider? What's the renewal probability of the sitting tenant? What new lease term do we expect to get out of either the existing tenant or a replacement tenant? And also, what sort of rent-free period are we going to have to offer to incentivize a replacement tenant or keep the current tenant in place? What's our expectation for ERV growth? This is another one where there's a lot of importance, I guess, attached to what growth expectations we're expecting if we're hitting market reviews or if we're resetting leases at a future point based on an ERV indexing. That's quite important. From the operating expense side, what is the business rate environment going to look like through a hold period? What service charges can we expect? What capital expenditure profile we might expect? If the property is a little bit older, maybe it's a value-add investment that's been looked at, and we need to understand and take a realistic view on the capital requirements to put in during the hold period is an important one, and also the cash flow period itself. From a valuation perspective, that obviously has to be long enough to capture a lot of the expected tenant movements over the near term. And then from an investment perspective, it obviously needs to reflect the mandate of the potential acquirer or holder of that property. And with these new data requirements comes a question about where the information will get sourced from. So just pausing, I guess, on the discount rate, there are a lot of theories around how you would do this. Ultimately, what it comes down to is the risk associated with the subject asset or the subject portfolio of properties. One method that's used quite commonly across finance is to substitute the weighted average cost of capital in as the discount rate, which will take the risk-free premium and then apply the risk premium on top of that. So that WACC assessment is a pretty common method and one that's commonly used. The exit valuation is another data source that's going to be important. So for example, taking a view on what net initial yield an exit might involve, or potentially an equivalent yield or reversionary yield at exit is going to be important. What leading up assumptions are going to be valid during the hold period? Would you take a consistent view, or would you take a more tenant-specific view based on the sitting tenants? ERV growth, I've seen some groups in this respect prepare pretty sophisticated supply and demand models that get called net absorption models, where you would look at a particular location, look at the demand, how that's changing, what the supply window looks like, and try and understand where the push and pull points are on supply and demand. And then you've got operating expense growth as well. So how a potential valuer would look at this from a CPI projection perspective. Maybe there's internal research teams that are preparing and projecting CPI growth. And then also other operating expense growths around service charges and business rates as well. As I understand it, RICS do prepare a PCIS database that would be quite valuable for augmenting what's required from an assumption perspective here. And then finally, the capital expenditure, whether this is a client input and potentially overlaid with valuer judgment over what's realistic for an asset of that type. So those are just some of the considerations, I guess. And I guess picking up on your point before, Dan, the report that you've obviously authored recently around the future of property valuations, I'd be really interested in understanding what your thoughts are around some of the additional data requirements and the challenges this presents for the industry.
Yeah, well, I mean, that's a really brilliant summary. So thanks for that. It was really interesting, I think, to see how, as an industry, we often think we're quite data driven, but we use a very narrow number of data sets. I think one of the challenges is, as you pointed out, both the future cash flows and also the risk or the discount that's used, I think, are going to be varied and affected by more and more different factors. So as we go through over time, we're going to have to use more and more data sets to inform that as we go. And I think that the report itself calls out predictive analytics. And I think really what they're meaning there is use of more technology to use more data generally rather than anything specific. And I think that the sector is going to have to come to terms with all sorts of different things. So to give a couple of examples, RICS themselves launched a new standard a couple of weeks ago called IBOS, which is about building operation. And within that, it identifies 5 pillars of performance. And those pillars are around the economic aspects, which are obviously key to everything we're talking about, but it's also sustainable, performing, compliance, and functional or functionality. And I think there's going to be more and more data that a valuer needs to use to understand what those cash projections are going to be and what the risk is going forward in the coming years and decades. I think this will be a long evolution. So I think there are a lot of challenges around that. And as people start using more data, that becomes more of a challenging situation, going from a simple spreadsheet to using tools such as Forbury to really manage this. But crucially also, I think one of the challenges is about transparency and being able to have an audit trail and understanding what's gone in so it can be regulated and reported back to clients. So I think there are going to be lots of challenges with data, but I think this is a really good step forward. I think it's going to become more important to have a wider range of data to inform what you're doing, but also the transparency about what you're doing and why you've done it.
And I guess the aspects around cultural change that you touched on there, Dan, are quite important as well. Moving to an approach where DCF valuation is recommended by the governing body, the self-governing body in this case, and then a skill set that has to get learned and applied as part of it is obviously a big change, a big move forward. What are some of the opportunities and challenges do you think that present as a result of that?
I think that's a great question. I think in all my experience working in data and technology in the property sector, I think the single biggest challenge is always culture. So it's very rarely the data and technology aspect. And that's not necessarily a criticism of property. So we're a sector that is an attractive investment class because we are slow and stable and counter-cyclical, and it's tangible. And if you leave a building today, it's probably there tomorrow. So all of our culture is built up about that slow, low risk, backward looking, evidential basis. And now we're talking more and more about being forward looking and using more data sets and making more assumptions. So for sure, there's going to be skills around how you do valuation, how you use data, everything around that. But for me, it is going to be that cultural shift that's the biggest one, to explore all of the new data sets that are available, work out which ones are going to have an impact and which ones don't, to make sure that we shift from being very backward looking to forward looking, and recognize that there will be some risk in what you're doing with forward looking assumptions. But at the same time, it's that transparency. And one of the things I said about valuations, it's an art, not a science. And that's not really something I buy into. I think that really what that means is it's a human brain using huge amounts of data that a computer can't keep up with. But if there's one thing that computers can do, it's keep up with a lot of data. And so I think that there's going to be this cultural shift of going from very narrow amounts of data that's backward looking to huge amounts of data looking forward. And again, I think that's why it's going to be important to have the right tools in place to allow you to do that, to allow you to put your human advice on top of that, which I still think will be crucial, but also to give that transparency and the ability to absorb all those data sets. Do you think the same thing, Scott? Does that sound fair to you?
Yeah, I do. And a culture of change in any organisation, any sector is hard, especially when you consider how what sort of tenure, I guess, property valuation as a sector's had. It goes well back before computers, and I think a lot of methodologies that would have been quite important, back in the 30s, 40s, 50s, and beyond, where that was, very much a constraint, is something that has had to be worked on. If you look at today and definitely look at some of the standards around DCF, it's not exactly a new technology, but it does require new information, and those forward-looking aspects around it are quite important aspects as well. Really interested as well, Dan, and I guess something we touched on when we were talking about this call yesterday is the impact of ESG as well on how valuations might get performed. And whether that's direct or indirect. Really interested in your view, I guess, on how you would see that playing out in the space for property valuation professionals, those that are relying on them for market transactions. What are your thoughts on that?
Well, yeah, I think it's a really important topic. And of course, ESG is the sort of buzzword that's being used at the top of everyone's agenda, but it's a really positive step forward. I think one of the big shifts that real estate has gone through over the last decade, perhaps, and I think things like COP26 or COVID in particular have really accelerated this, is that we're much more aware of the impact of buildings on people or society or the planet. And I think in the past, we've just looked at them as concrete blocks. We're now becoming much more human focused, which has to be a really positive step forward. But that also brings risks and challenges with it. So as data becomes available on, for example, air quality, then how does that, and that informs occupiers' decisions, how do you start building that in? I don't think we're really at the stage yet where that has a massive impact on the decisions about where to go. Leases are still relatively long. But as we see a growth in co-working spaces and flexibility and uncertainty over whether people want to be in all the time or at home all the time, in my view, it's going to end up being largely a balance between the two, is that information about things like air quality will start driving behaviours, which will start driving cash flow, which will start then affecting the value. So I think there's going to be a really big impact. I think at the moment, a lot of the focus has been about environmental, so air quality, sustainability, carbon, and so on, which is fantastic. I think the impact on society and the governance of that is going to be something that comes up more and more in the future. So the societal, how is it working for people and the wider society around the building, I think will be more important. I think the jury's probably out on what data points you'd measure that with. And there's an argument that you need some form of standards or standardization about what we mean. And I think governance as well is a little bit difficult. To understand what data sets are there to measure it will be challenging. But for sure, I think that the governance around a building, for example, we're putting technology in buildings all over the place, sensors and so on. And they have huge benefits in efficiency and better customer service, but they do bring their own risks with it as well, around privacy and data breaches and cyber. So how do we make sure that we're conscious that when we're valuing a building, we understand everything that we've spoken about in terms of how it works, cash flow, the business element of it, but also understand how the factors like sustainability, like society, like the governance affects those decisions that occupiers of the future are going to make, which in turn affects those cash income flows. So I think there'll be a lot of different data sets being used to inform those 2 points in particular you said around the discount rate and the cash flow. I think there'll be more and more data that's going to be used.
Yeah, it's an interesting point. Certainly thinking back to 2 years ago, almost 2 years ago now, when the pandemic really kicked off, and the first, I guess, group at risk and exposure was retail tenants, and a lot of rent relief that was being poured into basically keeping tenants in place and not losing them through bankruptcy and other measures. So, having a tool and making use of toolkits and approaches like DCF that do take into account a forward view on both the growth opportunities, but also where short-term blips come up that haven't been forecast, so that you can understand the impact of a valuation on a portfolio and understand the risk that means from a governance perspective is going to be increasingly important, I think, from a governance perspective in this space as well.
Yeah, I think that's spot on. I mean, I think a lot of the RICS report more broadly is about trust and making sure that there's an independence and there's a sort of a clarity there in the beginning, in the opening statement, saying that it doesn't feel like a big step that valuations could be independently regulated and separated out from the rest of the businesses, and that's not what the report calls for. But it's not a big step. So I think that one of the things that's really important is that we are much more transparent as a sector about what we're doing, how we're coming up with the calculations. And often the transparency about what we're doing to feed into the DCF, which is a better way of doing it, a more transparent way, I think, is a really good step forward, even if the answer's not spot on, because who knows where things are going in the future. At least it's a very transparent, trusted way of having a way to identify value and to benchmark and perform, to compare against the market.
Absolutely. Right.
I think that's probably time to start kind of wrapping things up now, guys, but it's been massively useful session. I've definitely learned a lot, and I'm sure probably everyone else has on the call. So I just want to thank to you, Scott, and also Dan and the Forbury team for putting this on. We are going to have another webinar coming out, which I think is the 16th of March. So if you're interested, it'd be great to have you on that as well. And we're going to be sending out the recording to everyone after we close the session. So anyone that's missed it or anyone wants to forward it on or whatever, then feel free to do so. Cool. Awesome. Well, yeah, thanks guys. And yeah, thank you everyone for taking the time.
Thanks, Ed.
Thanks very much.
Thanks, Dan.
Cool. Cheers guys. All the best. Bye bye bye.